Canadian Mortgages, Part 1 Foot. Mortgage, a mortgage loan, also referred to as a mortgage, is used by purchasers of real property to raise funds to buy real estate or by existing property owners to raise funds for any purpose while putting a lien on the property being mortgaged. The loan is secured on the borrower/his property. This means that a legal mechanism is put in place which allows the lender to take possession and sell the secured property to pay off the loan in the event that the borrower defaults on the loan or otherwise fails to abide by its terms. High-ratio mortgage. A high-ratio mortgage is one of the Canadian mortgages in which a borrower places a down payment of less than 20% of the purchase price on a home. Another way of phrasing a high-ratio mortgage is one with a loan-to-value ratio of more than 80%. A mortgage with more than a 20% down payment is called a conventional mortgage. A high-ratio mortgage will require mortgage insurance. Mortgage insurance is usually purchased by the lender through one of Canada's 3 default insurers. 1. Canada Mortgage and Housing Corporation. 2. Genworth Financial. 3. Canada Guarantee. The cost of the premium is added onto the mortgage and amortized over the length of the mortgage. It can also be added to the closing costs, however this is not the norm. Conventional mortgage. A conventional mortgage is a loan for no more than 80% of the appraised value or purchase price of the property. To qualify for a conventional mortgage, your down payment, or the cash you provide for the purchase price, must be at least 20% of the purchase price. A mortgage in which more than 80% of the fair market value of the property, also called the lending value, is referred to as a high-ratio mortgage. The ratio is the percentage of money borrowed in comparison to the value of the property. Types of Canadian mortgages. Most lenders offer 2 types of mortgages. 1. Open. 2. Closed. The main difference between open and closed mortgages is the amount of flexibility you have in making extra payments on the principal or in paying off the mortgage completely. These types of extra payments are called prepayments. Open mortgages allow you to make prepayments whenever you want. Closed mortgages often include prepayment privileges, which give you the option to make prepayments up to a certain amount. By making prepayments, you can save thousands of dollars in interest charges by paying down your mortgage faster. However, if you have a closed mortgage and want to make a prepayment that is more than your privileges allow, your lender will generally require you to pay a prepayment charge. These charges can cost thousands of dollars, so it is important to know when they can apply and how they are calculated. For terms longer than 5 years, if you want to break your mortgage and at least 5 years have passed, your lender is only allowed to charge 3 months' interest on the remaining mortgage balance. This may be less costly than other methods of calculating a prepayment charge. When you shop around for a mortgage, look carefully at the prepayment privileges and charges as you consider your options. For more information, see Mortgage Prepayment, Know Your Options. Open mortgages. You can make prepayments at any time during the term, or even pay the mortgage off completely before the end of the term, without having to pay a prepayment charge. The interest rate on an open mortgage is usually higher than on a closed mortgage with a comparable term length. An open mortgage may be a good choice if 1. You plan to sell your home soon. 2. You intend to make large prepayments that would be more than the amount you would be allowed to prepay with a closed mortgage term.